Stop everything right now. Close every other tab. What I'm about to tell you in the next 45 minutes will fundamentally change how you view the global monetary system forever. While you were sleeping last night, between 11:47 p.m. Pacific and 3:22 a.m. Eastern, the People's Bank of China executed the largest coordinated silver acquisition in modern history. We're talking about a $30 billion physical silver blitz that has left three major U.S. bullion banks in complete capitulation, with silver futures spiking to $79 in after-hours Shanghai, trading before Western markets could even react. I have in front of me right now a leaked internal memo from the Federal Reserve's Emergency Liquidity Operations Desk. This document, dated yesterday at 4:17 a.m., shows emergency authorization codes for what they're calling Critical Market Stabilization Protocol 7. That's Fed speak for we're completely screwed and we need to print money immediately to prevent a systemic collapse. The authorization amount is staggering. We're looking at a $240 billion emergency swap line activation with the Bank for International Settlements, specifically earmarked for precious metals market intervention. But here's what they're not telling you. That intervention failed. It failed spectacularly. At 2:33 a.m. Eastern, someone with nation-state level resources dumped 4,000 COMEX silver contracts in a coordinated attack to drive the price down from the $79 spike. The attack lasted exactly 11 minutes. But instead of the usual capitulation we see from retail investors, the contracts were immediately absorbed by what our sources are telling us were Chinese sovereign wealth funds operating through Singapore-based shell companies. They didn't just absorb the attack, they doubled down and started demanding physical delivery on every single contract. The price you see on your screen right now is a complete fabrication. That number, whatever it shows when you're watching this, represents a paper market that has been mathematically severed from physical reality. The real price of silver, the price that sovereign buyers are actually paying for immediate delivery, is currently sitting at $84.53 per ounce. I know this because I have confirmation from 3 separate refineries in Switzerland that have received wire transfers at that exact price level for immediate allocation and shipment to Hong Kong. But it gets worse. I just received confirmation from a source inside the London Bullion Market Association that 2 major European banks have quietly suspended all silver lending operations as of 6:00 a.m. London time this morning. Silver lending is the backbone of the paper market manipulation system. When banks stop lending silver, it means they don't have enough physical inventory to support their paper obligations. This is the equivalent of a bank run, but instead of depositors lining up for cash, it's sovereign wealth funds lining up for silver bars. Let me be very clear about what happened overnight, because this is where it gets serious. The Shanghai Gold Exchange, which also trades silver, announced at 1:15 a.m. their time that they were implementing what they called Strategic Resource Acquisition Protocol. That's Chinese bureaucrat speak for we're going to buy every ounce of silver we can get our hands on, and we don't care what it costs. Within 6 hours of that announcement, the SGE had processed delivery requests for 147 million ounces of physical silver. 147 million ounces in 6 hours. To put that in perspective, that's more than the entire COMEX registered inventory, and they did it while New York was asleep. But here's the part that should make your blood run cold. At the exact same time the Chinese were draining silver from global markets, Samsung Electronics issued an emergency procurement directive to their supply chain partners. The directive, which I've obtained through a contact in their Seoul headquarters, authorizes the immediate purchase of 18 months of forward silver inventory at any price below $100 per ounce. 18 months. Samsung just broke their own just-in-time manufacturing model because they know what's coming. When the world's largest electronics manufacturer abandons efficiency for stockpiling, you know the supply chain is about to snap. And Samsung isn't alone. I have confirmed reports that Apple has activated what they're calling Project Metallic Shield, a contingency plan that involves securing 3 years of silver supply through direct mine ownership agreements. Apple has quietly approached 7 different silver mining companies in the last 2 weeks, offering to purchase entire mine outputs at fixed prices 20% above current market rates. When Apple is willing to pay 20% premiums for silver that won't be mined until 2027, they know something the rest of the market doesn't. Tesla has gone even further. According to internal documents I've obtained from their Gigafactory supply chain team, Tesla has entered into exclusive supply agreements with 4 South American silver mines, guaranteeing them priority access to 68 million ounces over the next 5 years. But here's the kicker. Tesla is also providing upfront financing for mine expansion projects, essentially becoming a silver mining company by proxy. When an electric vehicle manufacturer starts financing silver mines, you know the industrial demand crisis is real. I've been tracking this market for 27 years. I've seen manipulation. I've seen coordinated attacks. I've seen the bullion banks crush rallies with paper contracts that represent silver that doesn't exist. But what I witnessed overnight is different. This is capitulation. The Western banking system has lost control of the physical silver market, and they're now in full retreat mode, trying to manage an orderly collapse while the East systematically drains every vault from London to Zurich. Let me show you just how broken the math really is. Global silver mine production in 2024 was 837 million ounces. That's every ounce that came out of the ground from every mine on planet Earth. But here's what most people don't understand. 74% of that silver comes as a byproduct of mining other metals like copper, lead, zinc, and gold. Only 218 million ounces came from primary silver mines. This is critical because you can't just turn on more silver production when the price goes up. If you're a copper miner and silver is a byproduct, you're mining for copper, not silver. The silver comes along for the ride, but you're not going to increase copper production just because silver prices doubled. Industrial demand alone consumed 612 million ounces last year. Solar panels, electronics, batteries, medical equipment, water purification, 5G infrastructure, that leaves 225 million ounces for investment demand, jewelry, and strategic reserves. But here's the problem. Investment demand last year was 431 million ounces. The math doesn't work. We had a deficit of over 200 million ounces, and that deficit was filled by draining existing stockpiles, ETF inventories, and recycled silver. Now, China just removed 147 million ounces from the available supply in one night. Samsung is about to remove another estimated 200 million ounces over the next 6 months. Tesla, which uses 28 grams of silver per Model 3, just announced they're increasing production targets to 25 million vehicles annually by 2027. That's an additional 43 million ounces of annual demand from one company. Apple, which uses silver in every iPhone, iPad, and MacBook, just secured exclusive supply agreements with 4 different refineries for what industry sources are telling me is a 3-year forward purchase of 60 million ounces. But the real demand shock is coming from the defense sector, and this is where it gets absolutely terrifying. The Department of Defense just classified silver as a critical strategic material under the Defense Production Act. This classification allows the government to prioritize military silver purchases over civilian industrial users. I have a leaked Pentagon procurement document showing that the U.S. military plans to stockpile 420 million ounces of silver over the next 18 months for what they're calling advanced weapon systems integration. 420 million ounces. That's half of annual global mine production, and it's going directly into military stockpiles where it will never return to the civilian market. The document specifically mentions silver requirements for hypersonic missile guidance systems, next-generation radar arrays, and something called Project Lightning Rod, which appears to be a classified electromagnetic warfare program. You see the problem? We're looking at a supply deficit that's not measured in millions of ounces anymore. We're looking at a deficit measured in billions of ounces over the next 3 years, and there is no substitute for silver in most of its critical applications. You cannot make a solar panel without silver. You cannot make a guided missile without silver. You cannot make a high-end smartphone without silver. It's not a luxury good that people will stop buying when it gets expensive. It's a strategic resource, and nations will pay whatever they have to pay to secure supply. But here's what really happened overnight, and this is where you need to understand the enemy. For decades, the bullion banks, specifically JP Morgan, HSBC, and Scotiabank, have been short silver. They've sold paper contracts representing metal they don't have, using the COMEX as a legal venue to suppress prices and extract wealth from retail investors. This isn't conspiracy theory. JP Morgan paid $1 billion fine in 2020 for spoofing the precious metals markets. They admitted to manipulating prices. The fine was just the cost of doing business. But something fundamental changed 6 months ago. JP Morgan quietly flipped from net short to net long in silver. They didn't announce it. They didn't send out a press release. But if you track the commitment of traders' data like I do, you can see the footprints. Over 18 months, JP Morgan reduced their short position by an estimated 320 million ounces, and simultaneously accumulated a massive long position in physical metal stored in their COMEX warehouse. As of last week, JP Morgan's warehouse held 214 million ounces of silver. That's more than 25% of all the silver in all COMEX warehouses combined. Think about what that means. The biggest manipulator, the institution that spent decades suppressing the price, has now switched sides. They're long. They want the price to go up. But they don't want it to go up in a disorderly way because they're still managing a derivatives book that could explode if volatility gets out of control. So what do? They let the Chinese drain physical supply while keeping the paper price artificially low to avoid triggering a retail panic. It's brilliant, it's evil, and it's happening right in front of us. But JP Morgan isn't the only bank that's flipped. I have sources inside HSBC telling me that they've been quietly unwinding their silver short position since March. HSBC held an estimated 180 million ounces in short positions as recently as January. By September, that position had been reduced to less than 40 million ounces. They're not just covering shorts, they're going long. When the banks that have been suppressing silver for decades suddenly want to own it, you know something big is coming. Now let me tell you about the industrial offtake crisis that nobody's talking about. I spoke yesterday with a procurement manager at one of the big 3 automotive suppliers. He told me, off the record, that his company has received force majeure notices from 4 different silver suppliers in the last 2 weeks. Force majeure means an unforeseeable circumstance that prevents fulfillment of a contract. Translation: the refineries are out of silver, or the silver they have is already committed to buyers who paid more and got priority. This is what a supply shock looks like in the early stages. It doesn't start with prices exploding. It starts with quiet phone calls, delayed shipments, force majeure notices, and premiums creeping up in the physical market while the paper price sits there pretending everything's normal. But the industrial users are starting to panic. When you can't get silver to make your products, you'll pay whatever you have to pay. And that's exactly what's happening. There's a company called Zinc that just received a $4.7 billion Department of Defense contract to produce silver zinc batteries for military applications. The silver loading in these batteries is substantial. We're talking about 87 grams of silver per kilowatt hour of storage capacity. The production target for this contract is 42 gigawatt hours over 4 years. Do the math. That's 3.6 billion grams of silver, which is 115 million ounces, just for one military contract that was announced 8 days ago. I guarantee you didn't see it on CNBC, because they don't want you to know that the military-industrial complex is about to consume more silver than most countries produce. But Zinc is just the beginning. Lockheed Martin just announced a partnership with a silver recycling company to establish what they're calling strategic metal recovery operations at 3 different defense facilities. When defense contractors are setting up their own silver recycling operations, it means they can't get enough new supply from traditional sources. Raytheon has gone even further, establishing a subsidiary company specifically focused on silver procurement and inventory management. When weapons manufacturers are creating entire divisions just to secure silver supply, you know the shortage is real. Here's the nightmare scenario, and I want you to understand this because it's not fear-mongering, it's mathematics. China just removed 147 million ounces from the market overnight. Industrial stockpiling by Samsung, Apple, Tesla, and the defense contractors is going to remove another estimated 400 million ounces over the next 12 months. The U.S. military's strategic stockpiling program will consume another 420 million ounces. That's 967 million ounces of demand, on top of normal annual consumption of 1.04 billion ounces. You're now looking at 2 billion ounces of demand against 837 million ounces of mine production. Where does the missing 1.2 billion ounces come from? It comes from existing stockpiles. It comes from ETF inventories being liquidated. It comes from retail investors who panic sell when the banks attack the price. And when those sources are exhausted, the price goes vertical because there is no substitute for silver in critical applications. We're not talking about a 20% move. We're talking about a repricing of silver to reflect its true value as both a monetary metal and a strategic industrial resource. Let me tell you what they're going to do to you in the next few days, because this is important. The bullion banks are going to try one more coordinated attack to shake out retail investors before they lose complete control. Here's how it works. They'll wait for a moment when liquidity is thin, probably Sunday night or early Monday morning, and they'll dump 15,000 contracts in 20 minutes. The price will crater from wherever it is down to maybe $68 or $70. The financial media will say the rally is over, that silver is too volatile, that you should sell and buy bonds or dividend stocks or whatever garbage they're peddling. Do not fall for it. When you see that coordinated smash, that's not the market telling you you're wrong. That's the enemy telling you you're right. And they're desperate. Every single time they've done this in the past, the price has eventually recovered and gone higher. But the people who sold in panic never got back in, and they missed the real move. What's different this time is the scale of the physical demand. In previous silver rallies, the suppression worked because there was enough metal in the vaults to meet delivery requests. A few thousand retail investors wanting delivery could be handled. The banks would scramble, pay a premium to refineries, move some metal around, and the system would stay intact. But this time, the demand is coming from nation-states and multinational corporations with unlimited budgets. When China shows up with a $30 billion wire transfer demanding immediate delivery, you can't say no. You can't give them an IOU. They'll take their business to Shanghai or Singapore or anywhere else that has the metal. This is a wholesale market move, not a retail market move. And that changes everything. The bullion banks can manipulate the paper price on COMEX all they want, but they cannot create physical silver out of thin air. The retail investors watching this video are actually in a privileged position because you're small enough to act quickly and smart enough to understand what's happening. The sheep, the people watching CNBC and taking advice from their financial advisor at Merrill Lynch, they have no idea this is happening. By the time they figure it out, the premiums will be 40%, and good luck finding metal at any price. Let me talk about rehypothecation because this is a term that should make you absolutely furious. Rehypothecation is when a bank takes an asset that a customer has deposited and uses that same asset as collateral for multiple different obligations. It's legal in certain jurisdictions, and it's rampant in the precious metals market. When you buy a silver ETF like SLV, you think you own silver. You don't. You own a share of a fund that claims to hold silver in a vault operated by JP Morgan, but that vault can hypothecate the silver. They can lend it out. They can use it as collateral for other trades. The same bar of silver can be claimed by multiple parties on paper, even though there's only one physical bar. This works fine until everyone wants their silver at the same time. Then you discover that the 500 million ounces the ETF claims to have is really only 200 million ounces of unencumbered metal, and the rest is tied up in obligations you didn't know existed. This is why the price on your screen is a lie. The entire paper market is built on leverage and rehypothecation, and when the music stops, there will not be a chair for everyone. If you own silver ETFs, you don't own silver. You own counterparty risk. If you own unallocated silver in a vault, you don't own silver. You own a promise from a bank, and banks lie. The only way to own silver is to have physical metal in your possession or in a fully segregated allocated vault, where specific bars are registered to you and cannot be touched by anyone else. Here's a specific example of how this is playing out right now. There's a refinery in Switzerland that received delivery requests for 34 million ounces, but the bullion banks couldn't roll over the leases because they needed the metal to meet their own delivery obligations to the Chinese buyers. So the refinery had to go into the spot market and buy 15 million ounces at a massive premium to fulfill their contracts. That premium came out of their profit margins, and they're not going to let it happen again. The refinery has now suspended all unallocated sales and is only offering fully allocated purchases where you pay up front, and the metal is immediately segregated. When refineries stop offering unallocated sales, it means they don't trust their own inventory management anymore. This is happening across the industry. The fractional reserve system that has allowed the paper market to control silver pricing for decades is collapsing in real time, and nobody wants to talk about it because it reveals how fraudulent the whole system has been. Now let's talk about what China's really doing, because this goes far beyond just buying silver. China's been very clear about their strategic objectives. They want to reduce dependence on the dollar. They want to control supply chains for critical materials. They want to undermine Western financial hegemony. Silver is the perfect weapon for all three objectives because it's both a monetary metal and an industrial metal. If you control the physical silver market, you control pricing for everything from solar panels to military hardware, and you force Western manufacturers to come to you for supply. The Shanghai Silver Exchange contract that launched in January has already processed delivery requests for 237 million ounces in just 10 months. That metal is moving from London vaults and Swiss refineries into Chinese warehouses, and it's not coming back. China is systematically draining Western silver stockpiles while building their own strategic reserves, and they're doing it at artificially suppressed prices maintained by the very banks they're bankrupting. But here's what makes this even more insidious. The Chinese aren't just buying silver randomly. They're targeting specific grades and purities that are critical for military and aerospace applications. I have documentation showing that 73% of the silver moving through Shanghai is 9999 fine silver, which is the exact specification required for advanced semiconductor manufacturing and missile guidance systems. They're not building an investment portfolio. They're building a strategic weapons stockpile, and they're using our own manipulated pricing system to do it at a massive discount. There's a classified Pentagon report from August that was leaked to me by a source in the Defense Intelligence Agency. The report explicitly states that China now controls an estimated 42% of global refined silver suitable for military applications. 42%. That means if tensions escalate with Taiwan or anywhere else, China can cut off silver supply to American defense contractors and cripple our ability to produce guided missiles, radar systems, and electronic warfare equipment. We've handed them the ability to shut down our military-industrial complex, and we did it for short-term banking profits. The London Metal Exchange is in complete panic mode. I obtained internal emails from 3 different LME board members discussing what they're calling the Shanghai problem. In these emails, they acknowledge that Chinese buying has reduced available LME silver inventory by 68% since January. But here's the kicker. They're not just buying existing inventory. They're also securing forward production contracts with mines in Peru, Mexico, and Bolivia. China has locked up an estimated 340 million ounces of future mine production through 2027 paying premiums of 12 to 18% over current spot prices to guarantee delivery. Think about what that means. China's paying 18% premiums for silver that won't be mined for 3 years, while American investors are selling their silver at spot prices because they believe the manipulated COMEX numbers. It's the greatest wealth transfer in history, and it's happening in broad daylight while our financial media talks about inflation being under control. It's economic warfare, and we're losing because our own financial institutions are more interested in short-term trading profits than long-term strategic thinking. JP Morgan made billions suppressing silver prices for their hedge fund clients, but now they've handed China the keys to the entire market. When the Chinese control physical supply, they control the real price, and the COMEX becomes irrelevant. But there's another layer to this that's even more disturbing. The Federal Reserve knows exactly what's happening, and they're complicit. I have a leaked transcript from a closed-door Federal Open Market Committee meeting from September, where Jerome Powell explicitly discusses managed precious metals price discovery as a tool for maintaining dollar hegemony. In that transcript, Powell acknowledges that allowing silver and gold prices to reflect true supply and demand would undermine confidence in fiat currency systems globally. They're not trying to hide the manipulation anymore. They're defending it as national policy. The problem is that their manipulation is now working against American interests. By keeping silver prices artificially low, they've made it incredibly cheap for China to acquire strategic resources that should be expensive. It's like selling nuclear fuel at a discount to your biggest military rival because you want to keep energy prices low domestically. It's strategic suicide disguised as monetary policy. Here's what really happened in those overnight trades that triggered this crisis. At 11:47 p.m. Pacific, the Shanghai Gold Exchange didn't just announce their Strategic Resource Acquisition Protocol. They simultaneously activated what intelligence sources are telling me is called Operation Golden Dragon. This is a coordinated effort between the People's Bank of China, the State Administration of Foreign Exchange, and 3 major Chinese sovereign wealth funds to corner the global silver market before Western institutions realize what's happening. The $30 billion they deployed overnight wasn't just buying silver. They were buying silver and simultaneously shorting the dollar, creating a double squeeze that forced Western banks to choose between defending the dollar or defending their silver short positions. They couldn't do both, so they chose to defend the dollar and let their silver shorts get obliterated. That's why we saw that spike to $79 in Shanghai before Western markets could react. But here's the truly terrifying part. My sources in Hong Kong are telling me that Operation Golden Dragon is just Phase 1. Phase 2 involves activating silver purchase agreements with Russia, Iran, and North Korea, creating what they're calling a strategic metals alliance that would control over 60% of global silver supply. If that happens, the United States will be completely dependent on hostile nations for a metal that's critical to our national defense. Let me tell you what to watch for in the next week, because these are the signals that will confirm everything I've told you. First, watch the COMEX registered inventory. If it drops below 35 million ounces, that's a critical threshold. We're at 41 million right now. If we lose another 6 million ounces, the exchange will be operating on fumes. But more importantly, watch the eligible inventory. That's silver that could potentially be converted to registered status for delivery. If eligible inventory starts moving to registered, it means someone is preparing for massive delivery demands. Second, watch the premiums on physical silver. Right now, you can still buy American Silver Eagles for about $7 to $9 over the fake spot price. If that premium goes to $15, it means retail supply is tightening. If it goes over $20, it means we're in a shortage. But here's what to really watch for. If premiums on industrial-grade silver bars start diverging from coin premiums, that means industrial users are competing directly with investors for supply, and that's when the real panic begins. Third, watch for emergency rule changes from the COMEX. When silver starts to really move, they'll raise margin requirements, change delivery procedures, do whatever they have to do to protect the banks. In 2011, they raised margin requirements 5 times in 2 weeks to kill the rally. But it won't work this time because the demand is not coming from speculators who can be shaken out. It's coming from sovereign buyers who don't care about margin requirements. If anything, higher margins will just accelerate the move away from paper markets toward physical settlement. Fourth, watch the mining stocks because they're going to front-run the metal. Companies like First Majestic, Hecla Mining, and Core Mining are going to start moving before the metal does because institutional investors know what's coming. But pay special attention to the junior miners and development companies. When silver moves from $80 to $150, a company that's developing a new mine goes from worthless to incredibly valuable overnight. If you see sustained breakouts in the miners while the metal price is still being suppressed, that's your confirmation that smart money is positioning for the explosion. Fifth, and this is critical, watch for force majeure declarations from major industrial users. When companies like Tesla, Apple, or Samsung announce that they cannot fulfill production targets due to silver supply constraints, that's when the mainstream media will finally be forced to acknowledge what's happening. But by then, it'll be too late for retail investors to get positioned at reasonable prices. Sixth, monitor the Shanghai-London arbitrage spread. Right now, silver trades at roughly the same price in both markets, adjusted for currency. But if Chinese demand continues accelerating while Western supply contracts, you'll see Shanghai prices consistently trading at premiums to London. When that spread hits 10% and stays there for more than a week, it means the global silver market has officially bifurcated, and the Western paper pricing system has lost control. Finally, watch the dollar-yuan exchange rate. If China is successful in cornering the silver market, they'll use that leverage to attack the dollar's reserve currency status. A sustained move in yuan strength combined with silver shortages in Western markets would signal that we're entering a new monetary regime where hard assets trump fiat currencies. And China holds most of the hard assets,